They changed the rules in the middle of the game, and millions of dollars evaporated in seconds. It wasn't a coincidence, and it certainly wasn't a natural market correction. Silver didn't crash because a massive new mine was discovered overnight, and it didn't plummet because the world suddenly stopped needing solar panels or electric vehicles. It fell because a specific switch was flipped behind the scenes, a mechanic designed to force your hand and empty your pockets. If you were watching the charts this week, you saw a cliff dive that defied logic, but if you know where to look, the fingerprints of a much larger operation are all over this move. We are going to walk through exactly how this trap was sprung, why it keeps happening at the exact same price levels, and the critical signal flashing in the physical market that the paper traders are completely ignoring. The trigger for this collapse wasn't a mystery, it was a mandate. Early in the morning, right as traders were returning from the weekend, the exchange quietly increased the margin requirements. This sounds like boring technical jargon, but in reality, it's a weapon. When you trade silver futures, you are using leverage, putting down a small amount of cash to control a massive amount of metal. The exchange demands a deposit, a good faith payment. But when they hike that margin requirement overnight, every trader holding a position suddenly wakes up owing more money immediately. It's an instant debt. If you can't wire that cash in minutes, your broker doesn't ask you nicely to close your position. They sell you out. They hit the sell button at any price available, triggering a forced liquidation that has nothing to do with what silver is actually worth. But it gets worse, because this wasn't just a few traders getting a margin call. This was a stampede. Imagine a crowded theater where someone locks the doors and screams, "Fire!" That is what a margin hike does during a low liquidity period. The first wave of forced sellers drives the price down. That drop triggers stop-loss orders for other traders, which act as automatic sell orders. This pushes the price down even further, which then triggers another wave of margin calls for the people who thought they were safe. It is a self-feeding loop, a violent downward spiral that feeds on itself until the leverage is completely flushed out of the system. This is why the chart looks like a vertical line down. It's not price discovery, it's a forced execution. You have to ask yourself why this specific tool is used at such convenient times. History has a nasty habit of repeating itself in the silver market. Go back to 1980. Silver was going parabolic, threatening to break the entire financial system. What happened? The rules were changed. Buying was restricted, liquidation was forced, and the price was crushed. Fast forward to 2011. Silver touches $50, and suddenly, margin requirements are hiked repeatedly in a short window. The rally broke. Now look at today. Silver makes a run for the mid-80s, gains momentum, and boom, the margin hike hits exactly when the market is thin and vulnerable. It stops looking like risk management and starts looking like a strategy to protect massive short positions held by institutional players. This creates a bizarre reality where two different prices exist for the same asset. On one side, you have the paper price, the digital number on your screen that is being thrashed around by leverage and algorithms. On the other side, you have the physical price, the actual cost to buy a bar of silver in your hand. While the paper price screams that silver is crashing, the physical market is telling a completely different story. Premiums, the extra fee you pay over the spot price, often hold firm or even rise during these crashes. Dealers aren't panic selling. They are holding their inventory because they know the paper drop is artificial. This divergence is the smoking gun. If the world really didn't want silver anymore, physical sellers would be undercutting each other to get rid of it. They aren't. The reason the physical market ignores the panic is that the fundamentals haven't changed by a single ounce. The industrial machine doesn't care about futures contracts, it cares about conductivity. Solar panel production isn't slowing down. The demand for silver in electric vehicles, charging stations, and high-performance electronics is embedded in the hardware of the future. Mines take 10 years to come online. They cannot just flip a switch and flood the market with supply because the price went up for a week. We are in a structural deficit where the world consumes more silver than it produces, and no amount of paper manipulation can fix that shortage. The only thing a margin hike does is shake out the speculators who are betting with borrowed money. And this is where things took a turn that most retail investors missed. When the dust settles on a crash like this, you have to look at who is left holding the bag and who picked up the pieces. Forced liquidation is a transfer of wealth. It takes assets from weak hands, traders who are over-leveraged and emotional, and hands them over to strong hands, institutions, banks, and deep-pocketed accumulators who buy with cash and don't use leverage. These entities love a margin crash. It allows them to scoop up discounted assets without pushing the price up. They wait for the forced selling to exhaust itself, and then they step in. It's a purge. Terrifying if you are caught in it, but constructive for the long-term health of the market because it clears out the instability. So the next time you see the chart fall off a cliff without a single news headline to explain it, don't panic. Look at the signals that actually matter. Check the physical premiums. Are they collapsing or holding steady? Look at the inventory levels in the major warehouses. Are they draining or refilling? Watch the delivery demand. Are big players standing for delivery and taking the metal out of the vault? These are the truths that the paper market tries to hide. The game is designed to shake you out, to make you doubt your conviction right before the real move happens. The margin hike was the trap, the crash was the bait, and if you understand the mechanics, you realize that the story isn't over. It's just the next chapter in the war for real assets.